Good morning. We're just going to give it another 60 seconds for the rest of the participants to get let into the meeting, then we'll kick off. All right, good morning. Welcome to the SevenBridge June webinar. I'm Justin Ferraccio. There's a few new faces on the call, so I'll quickly introduce myself. I'm one of the partners at the firm here, and this is Chuck Eberly.
Hey, good morning. Welcome.
So the people that are new, we do this once a month for our clients, prospects, friends of the firm. You can really ask anybody to join this if you think they'll find some sort of benefit. But it's for us to talk about kind of current events, what's happening in the market, what's happening in the economy, kind of our thoughts on portfolio strategy. We'll cover a number of topics. We'll bring in guest speakers 2 or 3 times a year. So we're actively working on one for July or August. So we'll make sure we publicize that. Purpose of the call, we just kind of went over. This is not meant to be a substitute for your personalized questions or review meetings. All of that stays standard. You have the ability to ask questions during this call. You can put it in the chat. It comes directly to me. Nobody else sees it. We'll do our best to answer as many questions as possible. Any questions we don't get to, we'll reach out to you directly to answer it. Or if you have a question that's more pertinent to your specific information, reach out to us directly. So I'm going to go ahead and share my screen and we'll get going. Okay, so we're going to go through market performance, where we're at year to date. We're going to talk a little bit more about the cornerstone of SevenBridge investment strategy. And we have one pre-submitted question that we got from 4 different people, kind of in different formats. So we're going to go through that in a couple of slides, get through that one more directly. And then at that point, we'll take questions in the chat. So year to date, right? It's been a roller coaster every year. We've been up, we've been down, and now we're back to flat to, up 2 to 4%, right? So I think the S&P has held up well. NASDAQ has been more volatile. Russell is, it's more small and mid-cap companies that's still taking a while to recover. Equal weight S&P 500, basically, it looks at all 503 companies and weights them equally. So that gives you a more accurate representation of what the market's doing overall. And then just kind of a quick look at the bond ag. It's up about 1% this year. So we've talked about the volatility in almost every meeting we've had this year. We don't expect the volatility to end. We expect it to continue through the rest of this year. There's still a lot going on, but we still think there's more good stuff than bad stuff happening. And, we're optimistic it's going to be a positive year. We don't have a crystal ball though. So day by day, the news changes all the time.
Okay, so we're going to talk about, the building blocks of the market, but also the building blocks of the SevenBridge strategy. So I was back in Pennsylvania last week and had quite a few meetings. So I feel I have a pretty good pulse on, the questions that I got last week. And that's, last week when Justin and I were working on what to talk about today, it really came from those meetings. But when you look at how SevenBridge allocates assets, we do it by sector of the economy. So we want to talk today about, what does that mean? Why is it important to you? And how do we implement it? How does it, help us with returns, which is really, risk mitigation. It's what it comes down to. So building blocks of the market, there's 11 sectors of the economy. And, those are industry codes. So we'll go through, what are these 11? But the key is each of these sectors behave differently based on, different economic events. So macro factors have to do with, large influences to the economy and also to the market. And knowing how each of these, correlate with one another or act differently than one another. That's what gives us the ability to control risk in your portfolio.
So, which sectors tend to move together, right? So tech, discretionary spending, and communication services are highly correlated. And when you think about communication services, it is companies like T-Mobile, AT&T, Verizon, but it's really Google, Meta are the high flyers in that space, and they're directly correlated with tech and growth. Discretionary is, companies that people are spending more money on when they have more money. So when the economy is moving forward, growth is doing well, discretionary spending goes up. Staples, healthcare, utilities correlate together as well. Those are all more defensive, low market volatility, so they have a lower beta. A beta is a measure of risk. The S&P overall has a beta of 1. Staples, healthcare, utilities is about 30% less than that. Financials, industrials tend to go together as well. They're both cyclical, and they're tied to the economy, economic data, rates, those types of things. Energy and materials, they go together. They're tied to commodities and inflation. And then real estate and utilities, and they're both rate sensitive sectors. So, Chuck briefly touched on this, but when you're looking at the S&P 500 overall, it's weighted by market cap. So it's weighted by bigger companies have bigger allocation to the S&P 500 ETF or index. More than 30% of that is directly tied to tech companies and communication companies right now. We tend to be a little bit less in those sectors. So this is what we sit down and spend a lot of time in, is what sectors do we think will perform well moving forward with what we know? What sectors do we think have gone too fast, too quickly? And then on top of that, where can we control risk? So we don't control risk by, saying you should be 50% stock, 50% bonds, or 60% stock, 40% bonds. We control it by the types of companies we own, high quality, and then where they live and what sectors they live in.
I think one important aspect of, the exercise isn't, we don't sit down and try to guess what sector's going to do better. So what we do is we look at the S&P 500, as Justin just mentioned, about 34% is in tech. And if you look at the S&P 500, the top 10 companies account for about a third of the S&P 500. So it's very concentrated, the S&P. So we look at the S&P as a benchmark. We then adjust the sectors, tilt them. So we're really not guessing. We kind of look at, tech is overweighted in the S&P because of the top 10 companies. So to lessen the volatility, we control how much is in that concentration. And then once we set that allocation in your account, you figure, actually the moment after we put it in there, it changes because things are moving. So how do we manage that? We look at the targets for the sectors, targets for specific companies, and what tends to happen, we're not get outperformance or underperformance. When we get too much concentration, that's when we bring it back to balance. So we're not guessing on what sectors we like or what's going to happen. We can see that concentration starts to happen. We want to let it go so you benefit, but then we want to reset, the sector weightings and the individual stock weightings. Okay, how the big picture shifts leadership. So let's start with the frowny face, the sad face, recession fears. So you look, we just, we're still in the middle of the tariff situation. It's not over. We're still in the middle of it, but the big event with the tariffs were recession fears. And you saw Staples healthcare utilities outperform. You look at what got hurt the worst, it was tech, energy, financials. So you can see typically after something happens, you can easily identify what sectors got hurt, which ones did better. And that's what makes it difficult and why we don't try to guess what's going to happen, but we, it's more of a risk mitigation that we're doing. But you look at rate hikes, financials benefit, tax, real estate, utilities underperform, rising inflation, energy prices go up, material prices go up. Discretionary and staples tend to lag. So each large economic event is going to have an impact on sectors. And what we're looking to do is manage which ones correlate together and which ones don't and balance it out. Not to the point that you don't get return. We don't want to diversify to the point that it's just neutral, but we want to really look at risk mitigation.
Okay, so next we're going to get into a question that we've gotten in many different formats, but we kind of sat down and looked at it 4 or 5 different ways and boiled it down to essentially the question is markets versus headlines. What's really going on? So the markets are rallying despite alarming news. Recession, inflation, elections, and global tensions dominate headlines. And this disconnect is explainable when we understand how the markets really work, right? So there's constantly something going on in the news cycle. We just want to kind of boil it down a little bit further, right? So markets are forward-looking. So the markets move on expectations 6 to 12 months out. So they're typically looking a year in the future and trying to their best knowledge with all the data that they have, guess what's going to happen in the market, right? So current bad news may already be priced into where the market is today. We may get bad news that's not as bad as expected, and that can improve the market. And, part of this question that we keep getting is, what's going, with Iran and Israel and this new conflict that broke out recently. Why is the market not treating that? Why is the market not going down, right? So this is just one of the latest scary headlines to pop up, and why doesn't the market care? And it kind of boils down to 2 things. The first thing is Iran's military capabilities have been severely damaged over the last many, many years, decade, between sanctions and tactical strikes that have happened in the past. So that's one part. So that no one really expects them to pose a big threat to Israel. And the second thing is, how does it impact oil prices? What's it going to do to gas prices? And, again, given the sanctions that have been placed on Iran for years and years, they're not a major player in the world of oil at the moment, right? And what Saudi Arabia is doing and OPEC continuing to release more, as of right now, we're really expecting minimal or no impact to oil prices. I'll let you take this one.
Okay, so part of the disconnect is, the economy isn't the market. So it, we get different economic data points. There's, the economy, to figure out exactly what's going on is difficult. There's all these indicators. But, the economy kind of get a read different data points. Remember that the market is discounting the future, so it's looking ahead. So I think that's the real disconnect between the economy and the market. That when we get a reading on the economy, it's kind of current data where the market's discounting the future. The market does react to earnings, capital flows, and also people's emotions definitely impact what happens with the market. And I say this a lot, but you figure your portfolio, your public market securities that you own is the only thing you'll ever own in your life that you know what it's worth every moment. Everything else that you own, your house, cars, jewelry, art, you never know what that's worth till you go to sell it, right? You have an idea what it's worth, but the market, you get immediate feedback. Every day we get a reading on what your portfolio is worth. And that does have an impact, the economy does impact it, but they're not equal. Go ahead.
You can just finish. You're on a roll.
So when you look at the headlines, you know, you would think, well, we have this headline and it ought to impact the market. A lot of times it does the opposite of what you would expect. You know, a company has good earnings and the stock goes down. You know, war breaks out, you know, and, you know, the market did go down last week, you know, when it first happened, but, you know, it had a quick bounce back. So it makes you kind of scratch your head. You get a headline and what you expect to happen doesn't happen. So we have to remember what's really driving, you know, the big picture. So it's, you know, Fed policy, money supply, you know, big market drivers. You know, we get some bad economic data, the central bank comes in to support it, and it really outweighs short-term fears. So I think we need to focus on, you know, what are the bigger influencers more than the headlines. It's easy to look at the headlines and then expect a certain result, which sometimes happens, sometimes doesn't. But, you know, we're not looking at headlines. We're looking at, you know, individual stocks, you know, companies that we own, you know, how much we have in each sector, how they correlate with each other, and, you know, put the picture together to get a good long-term result.
Exactly. Well, if there's any questions, you can put them in the chat now. If you think of anything after this call ends, reach out to us directly. So we'll just give it a few seconds here, but I think we did such a thorough job. There's no questions.
Yeah, it's so
That's the
thorough.
first. But we are getting better at keeping it closer to 15 minutes, which I know is the expectation on this call. Sometimes we're going to go over, but please reach out to either of us directly with any questions. And we really appreciate you taking time out of your day to spend with us.
Yep. Have a great day. Thanks.
Bye.
Bye.